Ah, what is up? Yup, got the beater on. Anyways, today is day 5 or 6 so far. We have been over, let's see, candlesticks, trends, break of structure, and change in state of delivery. And today's topic is going to be very, very important. I might split it up into 2 or 3 sections. And it's pretty much the most important part about any strategy. Definitely the most important part about my strategy. And that is going to be liquidity. Yep. Liquidity it is today. So, liquidity is a super broad range because there's a bunch of liquidities. There's internal, external, and you can use different things for liquidity. But this is going to be the video on the introduction of liquidity, and probably two. I'll split it up into 2 videos. They might be a little lengthy. This one might be lengthy. But get your pen and paper ready because we are going to get right into it. So, yes, liquidity is the number one most important factor to this trading model, and it will make you thousands of dollars. But first of all, what is liquidity? So, liquidity is pretty much resting orders in the market, mostly stop losses of traders, or for retail traders, it's going to be their breakout entries. But we don't need to worry about retail traders. We make our money. You are going to make your money off of retail traders. So, you have 2 main sources of liquidity. Where did my little thing go? There we go. 2 main sources of liquidity. Buy side liquidity. And then you have, here, I'm going to move this right here. There we go. Buy side liquidity and sell side liquidity. Those are the only 2 types of liquidity there are. Buy side and sell side. Buy side liquidity is going to be orders resting above highs, and sell side liquidity is going to be orders resting below the lows. So price moves to liquidity because that is where institutions, what are institutions? Institutions are banks, need counterparties to get out so they can put their large positions in. I don't think I've been over this yet. But market moves because of banks. Banks literally put millions of dollars into the market at a time. And the way that you can get into the market is that you need to take somebody out of the market. So, put this into perspective. When I get in the market, I press buy, somebody else has to press sell. So, the only way that the banks and the institutions can place their orders is going to be where liquidity is. Because why? Liquidity is where, like I said, stop losses are. So if there's a bunch of stop losses right here, ready? This is going to be a great visual interpretation. I want to make this red. So let's say, look, stop loss, stop loss, stop loss, all above here, right? These are all millions of other traders' stop losses saying, I want to get out the market if it comes up here. The banks need, so like I was saying, I press buy, somebody else has to get out the market. So there's millions of stop losses above this buy side liquidity. So banks put $1 billion in, hypothetically, right? Millions of dollars in, and they need to take all these people out. So that is why liquidity is a thing, because that is where stop losses are resting in the market. And price moves because of institutions. So institutions put a lot of money in. They need a lot of other people to get out. So they get in at around where the liquidity is. So we have two types of liquidity. We have external. There we go. We have external liquidity. And we'll put this one right here. No, we won't. And then we have internal. Internal. There we go. And then we'll just put a big liquidity. There we go. Yeah, I like blue. We'll make this one a different color. We'll make it red. Okay. Internal and external liquidity. So external liquidity is going to be here. Okay. Bang. No. Okay. External liquidity is going to be major forms of liquidity. So it's going to be your higher time frames. So it's going to be the daily and the 4-hour time frame, or the weekly or the monthly, anything above the 4-hour time frame. And it's going to be swing highs, swing lows. So swing high slash low, or daily high slash low. Okay. So external liquidity is going to be your major liquidity. It's going to be anything from the 4-hour up, any swing highs, or daily highs and lows. Okay. And this is going to be where the majority, because remember, high time frame is key, right? Lower time frame is going to give you your entries. High time frame is where stuff actually happens. So the major banks are going to be getting in on the 4-hour and above time frames. They don't trade in the little time frames. So whenever you see liquidity that is external, you know it's going to be stronger, because that is where the banks are going to be getting in. Now, internal range liquidity is going to be smaller highs and lows inside of a range or a swing. Let's write that down for you, shall we? So this is going to be smaller moves, right? And it's going to be smaller highs and lows. So right now I'm on a 5-minute chart, right? So it's lower than a 4-hour. So that's how we know it's most likely going to be internal. And your liquidity, your internal range liquidity, it's going to be highs and lows like this. Buy side liquidity and sell side liquidity. So what do you see? Market takes out buy side or sell side liquidity and goes up and takes out buy side liquidity. This is going to be internal. It takes out internal liquidity. And if we go out on a daily time frame, actually 4 hours is going to be easier to look at. Oof, it's not a good example. We'll go into the examples after. Let me tell you guys the basics first. So, liquidity. External range liquidity is going to be on the higher time frames, swing highs, swing lows, daily highs, and daily lows, or even weekly highs, weekly lows, monthly highs, monthly lows. Internal range liquidity is going to be on the smaller time frames, usually the 15 minutes time frame and lower, and it's going to be smaller highs and smaller lows. Liquidity under the lows is sell side liquidity. Liquidity above the highs is buy side liquidity. Now you're probably wondering, what is, well, I'll just tell you guys. So the strongest form of liquidity, well, first of all, what why is liquidity important? Okay. Liquidity is important because that is where price draws to, right? So when I say your strongest set of liquidity, or your most important, your strongest set of liquidity, means that's where price is most likely to go to. And the most important and the strongest set of liquidity is going to be equal highs or equal lows. Now, what does equal highs and equal lows mean? So if you remember what I was talking about before, about in a different video, when I was talking about swing highs and swing lows, it's going to be when the lows of two swing lows are identical or near identical. Let me find right here. Okay. So as we can see, this is a low. We have low right here, and then another low right here. If you remember from the trading view video, when I showed you how to tell what the low is and the price of it, go on the candle with your crosshair, look at the top left, it's going to show you the low right here, right? Go on the candle, low is 24889.75. Go on this one, 24890, right? So, you go, sell side liquidity, put it on this low, and you see how they are pretty much equally low. That is going to be a strong price, is going to draw there. See how price just ran straight through it, straight to it? That is because it is a strong low. What else do you see down here, right? Another set of sell side liquidity down here, right? See how this low is close to this low? That is how you know price will draw to it. Same thing with a high for buy side liquidity. There is going to, so right here, there is sell stops resting right here, right? Banks see, oh, sell stops are resting right here. All these people are looking to exit the market, and now I can get in. And what happens? Look right here. Takes it out. Banks get in, and price skyrockets. Okay. Let me get rid of these drawings just because I don't like my chart cluttered up. Okay. So that is equal highs and equal lows. Now, an equal high or low is only equal low or equal high, or you can call it relatively equal. This is going to be relatively equal because they're almost equal. But the low that formed first has to be lower than the second low. So what I mean by that is this low has to be lower than this low. Why? Because if this low was below this low, you wouldn't consider that an equal or relative equal low because this set of sell side liquidity already got taken out. So the only way it is a relative equal high or low, which is your strongest draw on liquidity, is going to be, this is another example for your buy side liquidity. This high is above this high, but they're relative. They're close in price. So that is relative equal highs, buy side liquidity. Another example here for relative equal lows. This low is lower than this low. They aren't exactly equally low, but this one is lower than this low and they're close to each other, meaning price will take it out. Ooh, now let me get rid of this drawing. All right. So now that we have a basic idea of external, which is going to be your major higher time frame liquidity, and internal, which is going to be the smaller moves, you already know what equal highs and lows are, which is our strongest form of liquidity. You know what liquidity is and why it runs after. Why? Because that's where institutions get in, because it takes other people out of the market. Now, we have liquidity as previous day high and previous day low, which we will go right into. We have weekly and monthly lows, session highs and lows, and higher time frame liquidity that often price draws to. So that is what we will go over in the next video. Next video is going to be way more in depth. This one went over, so now you understand what liquidity is. We'll go over more actually right now. So let's look for our high time frame liquidity. Okay, so high time frame liquidity, swing low, swing high. This is going to be our high time frame buy side liquidity and our high time frame sell side liquidity, right? And it's just because those are the most recent swing highs and lows. We can even go down on a 4 hour so I can show you the relative equal highs and relative equal lows. Okay. Here we go. So over here, I want you to spot relative equal highs and relative equal lows on a high time frame. So right here, for buy side liquidity, you can see these two highs are relative, making this a strong buy side liquidity on a higher time frame. Takes it out and market dumps. Why? Institutions get in right here, say the market's going to go lower, and then price drops. So what I want you guys to do tonight or right now or after you're done taking these notes, I want you to go on TradingView, go back on your chart, and I want you to mark out your major external liquidity. I want you to mark out some internal liquidity. And then practice marking out previous day high and previous day low. Keep it marked on your chart. And then tomorrow you can check in and see how price reacts off that liquidity.